All right, let's talk Park Aerospace. We're diving into their Q3 earnings call, and let me tell you, this was a big one. It wasn't just about hitting the numbers for the quarter, no. This was all about a huge strategic shift that's setting the stage for what's next.
And right away, you see the impact. I mean, look at that. The stock popped almost 10% the very next day. So you have to ask, right? What was in that announcement that got the market so fired up? Well, that's what we're here to figure out. We're going to unpack the numbers, the strategy, the whole shebang. Okay, first things first, let's talk about the quarter they just put on the books. And honestly, it wasn't just about beating expectations. It was about showing they can really execute. This is the foundation, right? The solid ground they're building this massive growth story on top of. And when you look at the results, the quality just jumps off the page. Yeah, revenue's up a solid 20% to $17.3 million, which is great. But the real story here, it's the margins. A 750 basis point expansion. I mean, that's huge. And that's what lit a fire under their adjusted EBITDA, which shot up over 75%. So you see, it's not just growth for the sake of growth. This is seriously profitable stuff. But, as good as Q3 was, the real bombshell was in the guidance. This is where you see the massive step up we're talking about. Management is guiding for around $24 million in sales for Q4. Now think about that. They just did $17.3 million. That's almost a 40% jump from one quarter to the next. That's not growth, that's a rocket ship. Now there's a catch, and it's a really important one. That massive sales jump, well, it comes with a little asterisk. Management was super clear that over $7 million of that Q4 number is going to come from something called C2B fabric. And the thing is, that's a really low margin product for them. So that product mix is going to put some pressure on the overall profitability. It's why you don't see the profit guidance jumping quite as high as the sales number. It's a key detail you've got to understand for the next quarter. So you're probably wondering, where is all this demand even coming from? Well, management laid it out perfectly. They're building the entire company's future around what they call the two juggernauts. We're talking about two massive long-term waves of demand, one from commercial jets and the other from defense. Okay, juggernaut number one, the huge recovery in commercial aerospace. Specifically, we're talking about the Airbus A320 Neo family. Airbus is cranking up production, aiming for 75 of these planes a month. And where does Park fit in? They're a critical supplier for the CFM LEAP engine, the one from GE and Safran. And that engine is on almost 2/3 of all A320 Neos. So they've basically got a locked-in spot on the world's most popular airplane. Not bad. Now, the second juggernaut. This one's even more intense, and it's all about geopolitics. This quote from the Wall Street Journal really says it all, doesn't it? The Pentagon is basically telling its suppliers they need to double, maybe even quadruple missile production, and they need it done yesterday. It's all about refilling stockpiles that have been used up around the world. And this is Park's ace in the hole. They are the sole source supplier for some specialty materials on the PAC-3 missile system. We're talking about the stuff that basically acts as a heat shield. For one of the Pentagon's absolute top priority programs, Park is the only company that makes this stuff. They are literally irreplaceable in the supply chain. So think about it. You've got these two massive waves of demand coming at you from both commercial and defense. It's a once-in-a-generation opportunity. So what does management do? They make an equally bold move. They're making a $50 million bet on the company's future. And the plan is actually pretty simple when you break it down. Problem: this juggernaut demand is just overwhelming their current factories. Solution: build a new $50 million plant that will literally double their capacity. And how do they pay for it? They're setting up a $50 million at-the-market, or ATM program, to give them the cash and flexibility they need. So what's an ATM program exactly? Well, instead of selling a huge block of stock all at once, which can sometimes spook the market, an ATM lets the company sell new shares gradually, over time, right into the open market at whatever the current price is. It's just a much more flexible and, honestly, a less disruptive way to raise the money they need. And this brings us right back to that nearly 10% jump in the stock price. The market's reaction tells you everything you need to know. Investors looked at this plan and said, yes, we get it. They're way more excited about this massive growth story than they are worried about a little bit of share dilution from the financing. It was a huge vote of confidence in the strategy. All right, so let's recap. We've got a fantastic quarter, absolutely explosive guidance, those two juggernauts of demand, and a really bold plan to capture all of it. So now, let's put it all together. What's our take? What's the thesis going forward? So what is the next call on Park Aerospace? Let's break down the bull and bear arguments.
Okay, on the bull side, the story is pretty compelling, right? You've got that sole source status on critical defense programs. You're tied to the long-term aerospace recovery, and you have a management team that's investing aggressively to grab that growth. Now, the bear case is all about risk. Can they actually execute and build this new plant without a hitch? What about that near-term margin pressure? And of course, the potential for share dilution from the ATM. When we weigh all of that, for us, the rating is clear. We're calling this an outperform. We think the long-term strategic position and just the incredible scale of these demand drivers, well, they more than outweigh the near-term risks. So here's the next call. We think the stock is going to keep re-rating higher. Why? Because the market is going to start seeing Park less like just another cyclical supplier and more like what it is, a strategic defense asset that can't be easily replaced. And for that outrageous but plausible trade idea, listen to this. The trade isn't that Park gets bought out. The trade is that its sole source status makes it too critical to be acquired. It becomes this unique, untouchable asset that deserves a special kind of scarcity premium. This is not financial advice.